In June of 2026, the owners of a massive, heavily hyped Chicago office skyscraper basically looked at their spreadsheets, they looked at the physical building, and then they just handed the keys back to their lender.
Right. They just walked away.
Yeah, walked away from a $345 million loan. I mean, they didn't put up a fight. They didn't try to renegotiate for the fifth time.
Yep, total surrender.
Exactly. And today we are looking at the Q2 2026 earnings call for the company that was left holding those keys, which is Blackstone Mortgage Trust, trading under the ticker BXMT.
Which is a massive player in this space.
Right. And, if you think a corporate earnings call is just dry spreadsheets and a bunch of Wall Street jargon, you really need to read this specific transcript.
Oh, absolutely.
It reads like a financial thriller. It's all about survival, the brutal triage of bad assets, and just this radical transformation of the commercial real estate market that's happening right in front of us.
Yeah, the raw data in this transcript is basically a real-time stress test of one of the largest players in real estate debt.
Okay, let's unpack this because our mission for this deep dive is to translate this really dense financial transcript into a clear, actionable story for you.
And we are watching institutional capital react to a world where the fundamental cost of money has just completely shifted.
Right, and we've got the raw earnings call transcript from July 30th, 2026. This includes management's prepared remarks, but also the notoriously revealing Q&A session with Wall Street analysts.
Which is always the best part. For years, the commercial real estate market operated on this very specific set of assumptions about interest rates.
Yeah,
right?
yeah.
And those assumptions have totally evaporated. BXMT's latest quarter shows us exactly what happens when the tide goes out.
And in that Q&A, you really get to see the tension between the polished corporate narrative and the cold, hard math.
Because Wall Street analysts are paid to find the cracks in the foundation.
Exactly.
And in this specific call, they were incredibly focused on the tension between BXMT's historical identity, as this massive commercial skyscraper lender, and the really aggressive pivot management is trying to pull off right now.
Yeah, the core tension here is that BXMT is actively steering a multi-billion-dollar ship away from legacy office buildings. I mean, those massive towers that used to be the gold standard of real estate investing.
Right, they're turning toward entirely new frontiers.
Well, before we get to those new frontiers, we have to look at the scoreboard for the second quarter.
The headline numbers.
Exactly, and these numbers paint two aggressively different pictures of this company's health. You really have to peel back the layers here.
The divergence in the top-line metrics is just striking. So on one hand, you have the GAAP net loss, which came in at 48 cents per share.
Which is ugly.
It's a steep drop, especially when you compare it to the net loss of just 4 cents per share they reported in the first quarter of 2026.
Right.
So under generally accepted accounting principles, GAAP, the company is deeply in the red.
But then, literally in the very same breath on the call, management highlights their distributable earnings, or DE, which they reported as a positive 31 cents per share.
Right, which sounds like a total contradiction.
It does. And as someone looking at the stock, the DE number is usually the main event because BXMT is a real estate investment trust, a REIT.
And legally, they have to distribute the vast majority of their taxable income to shareholders as a dividend.
Exactly. So retail investors are laser focused on DE because that's the cash engine funding their payout. But losing 48 cents on paper while claiming to make 31 cents in distributable cash, we need to look at the mechanics of why both of those numbers can actually be true at the same time.
Well, the divergence really comes down to the fundamental difference between estimating future risks and measuring current cash flow.
Okay, break that down.
So GAAP accounting is designed to be highly conservative. It forces companies to record paper losses for things that might go wrong in the future, or for the depreciation of assets on their balance sheet.
Right, the stuff that hasn't literally cost them cash yet, but probably will.
Exactly. Distributable earnings, however, is a non-GAAP metric that strips all of those non-cash accounting estimates away.
So it's just the cold, hard cash.
Yes. DE is management's way of showing the market the actual cash-generating power of the business over the last 90 days.
Okay, so it tells you how much cash actually came in the door from interest payments minus the cash that went out for expenses.
Precisely. The paycheck is still clearing.
But the transcript gets even more granular with that DE number. Management noted that their DE prior to realized gains and losses was actually 48 cents per share.
And that specific metric is crucial.
Right, because the quarterly dividend they pay out is 47 cents per share. So before accounting for actual realized losses, the cash coming in just barely covered the cash going out to shareholders.
A 1-cent margin of safety.
Yeah, not exactly a comfortable cushion, but I have a major bone to pick with the broader health of their balance sheet here.
The book value.
Yes. The transcript clearly states that their book value per share, like the literal net worth of the company divided by its shares, declined by 4% in a single quarter. It dropped to $19.31.
Which is a huge hit.
A 4% drop in 3 months is a flashing caution light for the whole portfolio, isn't it? I mean, isn't that a huge red flag?
It is a massive hit to the balance sheet. I mean, you can't ignore that. But to understand the drop, you have to trace it back to a specific accounting standard that drove the GAAP loss in the first place.
Okay, lead the way.
The decline in book value was largely driven by an 80-cent per share increase in their CECL reserves.
CECL, one of those acronyms that just puts retail investors straight to sleep.
It does, but it's the entire key to understanding this quarter. CECL stands for Current Expected Credit Losses.
Right. Okay. Explain how that actually works in practice.
So prior to the 2008 financial crisis, banks operated on what was called an incurred loss model. They only recognized a bad loan when the borrower actually stopped paying.
Meaning their balance sheets looked totally healthy right up until the literal moment they imploded.
Exactly. It was a disaster. So regulators changed the rules and created CECL. This forces lenders to look at a loan the very day they make it, look at the macroeconomic environment, and estimate the expected lifetime credit losses for that asset immediately.
Basically forcing them to be pessimistic upfront.
Right. The mechanism requires lenders to essentially look into a macroeconomic crystal ball.
Which is tough right now.
Very tough. If interest rates rise, or if a specific sector like office buildings shows weakness, the lender has to increase those reserves.
And in Q2, BXMT increased their CECL reserves by that massive 80 cents per share.
Yeah. Their total reserves now sit at $2.43 per share across the company.
Wow. And management broke that down, right?
Yeah, into a $1.13 general reserve, which is just a broad buffer for the portfolio.
Like a rainy day fund.
Exactly. And then a $1.30 asset-specific reserve, which is tied directly to loans they know for a fact are in deep trouble.
So that 80-cent jump in a single quarter is management explicitly saying, you know, we expect to lose this money eventually, so we are taking the hit on our balance sheet today.
Yes. It's a direct reduction in the book value.
To put this in a relatable context for you listening, looking at GAAP and book value is essentially like looking at the estimated value of your house on Zillow during a severe local recession.
That's a great way to put it.
Right. The paper value is dropping, the equity you thought you had is shrinking, and it feels really alarming. But looking at distributable earnings is like looking at the actual cash from your paycheck that hits your checking account.
You can still buy groceries.
Exactly. You can still pay your bills. The cash flow is still functioning, even if your net worth on paper took a severe hit.
And in this case, that DE of 48 cents covered the 47-cent dividend, but the paper value took a hit because they see a massive storm hitting specific parts of their portfolio.
Which parts specifically?
Well, the vast majority of that 80-cent increase in credit reserves wasn't just a broad adjustment. It was highly concentrated. It was driven by one glaring, massive problem child in the Midwest.
Which brings us right back to that Chicago default from the intro.
Exactly.
And this wasn't some minor property. This was a $345 million office loan they originated back in 2018.
And the borrower completely defaulted in June. Just handed the property back.
But this default wasn't a sudden shock to BXMT, was it?
No, not at all. The transcript notes they actually downgraded this specific loan to their internal watch list way back in 2022.
So they saw this coming for years.
They did. They knew the Chicago office market was facing severe headwinds coming out of the pandemic.
Yeah.
But what's fascinating here is the behavior of the borrower before they gave up.
Yeah, President Austin Pena pointed this out on the call. He said this borrower actually secured over 500,000 square feet of leasing over the last 2.5 years.
Which is incredible.
That number literally stopped me in my tracks. 500,000 square feet is a staggering amount of leasing activity. It means companies were actively signing contracts to move into this specific building.
It wasn't an empty ghost town.
Right. If you're securing that many leases, it should be generating cash. So why on earth does a building with that much leasing momentum still default?
Because leasing commercial real estate is incredibly capital intensive.
How so?
When you sign a new tenant for an office space, you don't just hand them the keys and say welcome. The landlord has to pay for tenant improvements.
Like remodeling.
Yeah, literally tearing out walls, putting in new carpets, rewiring the IT infrastructure to suit the new company.
Oh, wow. Okay.
And they also have to pay massive leasing commissions to the brokers who arranged the deal in the first place.
So it costs money to make.
A lot of money.
Yeah.
The borrower for this Chicago property was doing everything right. They were investing incremental equity, pulling fresh cash out of their own pockets to fund all of those tenant improvements and commissions.
They were trying to lease their way out of the problem.
Exactly. But they were fighting a war on two fronts.
Right. Because while they were spending millions to get tenants into the building, the cost of the floating rate debt on that $345 million loan was just skyrocketing.
Because of the Federal Reserve's aggressive rate hikes.
So the fundamental math of the building just broke. The cash coming in from the new leases simply could not outpace the massive rising interest payments and the upfront capital costs of actually securing those tenants.
The gravity of the Chicago market headwinds combined with the cost of capital just crushed their business plan.
It's brutal.
It really is. And this single loan highlights the broader pain in their portfolio. The total watch list for BXMT currently sits at $2 billion.
$2 billion on the watch list. Now, management was quick to point out that this is a 23% reduction from the previous quarter.
Yeah, which they framed as a significant win.
Of course they did. But CEO Tim Johnson immediately highlighted a very specific $1 billion subset within that watch list that is feeling intense pressure.
Yeah, that $1 billion subset represents roughly 5% of their total investments.
And we are talking predominantly about legacy office assets with lower in-place cash flow. This is where the psychology of institutional real estate finance gets incredibly interesting to me.
Oh, the psychology is fascinating.
Right, because the borrowers holding these troubled loans haven't just been sitting on their hands ignoring the problem.
Not at all. Johnson specifically noted that these institutional borrowers have invested nearly $800 million of subordinate capital into these exact assets since the end of 2023.
Oh, wait, okay. For anyone not deep in the weeds of commercial capital structures, subordinate capital usually means the borrower's equity or like a secondary riskier layer of debt.
Exactly.
It is the money that gets completely wiped out first if the building goes into foreclosure.
Yes, it's the buffer.
So these borrowers took $800 million in fresh, cold, hard cash and just threw it at these struggling buildings over the last 18 months. They effectively doubled down on assets that were already on a watch list.
They were throwing good money into a burning building.
Why? If you're a borrower and you've already sunk millions into saving a building, why do that if you're eventually just going to hand the keys back? Is it purely a math equation at that point, or is there a psychological surrender happening?
Well, you have to understand their expectation at the time they invested that money. At the end of 2023, the prevailing narrative across Wall Street was that inflation was beaten, right?
Right. Everyone thought rate cuts were coming.
Exactly. The assumption was the Federal Reserve was going to aggressively slash interest rates in 2024. These borrowers were playing through a challenging environment, making this calculated gamble.
The gamble being, if we can just keep the building afloat for a few more months with fresh cash, rates will drop.
Yes. Their interest payments would plummet, and the asset would regain its value.
But the reality of 2026 hit them like a freight train.
It sure did.
I mean, the transcript notes that the 10-year Treasury yield is actually up more than 60 basis points since early March of this year alone.
Which is massive.
Yeah, a basis point is just 0.01%, so 60 basis points is a 0.6% increase. That might sound like a rounding error to a normal person, but when you are carrying hundreds of millions of dollars in floating rate debt, a 0.6% increase completely annihilates your profit margins.
The rate cuts didn't come fast enough or deep enough to save them. And that leads directly to that psychological and mathematical breaking point you asked about.
The end of extend and pretend.
Exactly. For years, the mantra in commercial real estate during tough times was extend and pretend. You go to your lender, you ask for an extension on the loan maturity, you pretend the asset hasn't lost 40% of its value, and you wait for the market to recover.
And lenders allowed it because they didn't want to take the loss on their balance sheets either.
Yeah, exactly. Nobody wanted to face the music. Yeah. But the willingness to extend and pretend requires hope. It requires the borrower to genuinely believe their equity isn't truly wiped out.
And when a loan reaches a maturity date in this current environment, the lender usually demands a massive capital paydown, a chunk of cash, to reduce the principal in exchange for an extension.
Right. And now, The borrower looks at the 10-year treasury, looks at the struggling leasing market, calculates the present value of the future cash flows against the cost of the debt, and realizes the math is dead.
They realize the $800 million they just sunk into the building is gone forever.
And they simply refuse to throw another dime after it.
That is exactly what Tim Johnson warned about on the call. He explicitly stated that some borrowers may be, quote, less willing to invest subordinate capital than they have been in the past.
Which is corporate speak, for they're walking away. We are witnessing the capitulation of the extend and pretend era for this specific vintage of office loans.
And the casualties are actively mounting. It wasn't just the Chicago skyscraper. The second quarter saw 3 new impairments added to the list.
Yeah, a Denver office loan, a hotel loan in Hawaii, both of which were originated prior to 2023, and a multifamily loan in Melbourne, Australia.
Now, that Australian default is really surprising because management noted earlier in the year that Melbourne has less than a 2% vacancy rate for apartments. That's a fundamentally strong market.
It is. But what's fascinating here is it reinforces the reality that even in a highly demanded market, the specific capital structure of a loan can still be its undoing if interest rates stay higher for longer.
Because the debt costs eat everything.
Right. If the debt was underwritten, assuming a 3% interest rate, and the borrower is suddenly paying 7%, a 2% vacancy rate won't save them.
The compounding pain from this $1 billion subset of rate-sensitive office loans is exactly why management isn't just sitting in their boardroom waiting for a miracle rate cut.
They can't afford to wait.
No, they are actively amputating the infected parts of the portfolio. They are aggressively dumping legacy assets.
Yeah, they have already reduced their overall office exposure from a peak of 36% of their portfolio down to just 21% today.
That is a massive rotation. And CEO Tim Johnson stated a very clear, highly actionable goal on the call. He wants to reduce office and legacy pre-2023 loans by, quote, 40% or more by year-end.
To put that in perspective, trying to shift the composition of a multi-billion-dollar debt portfolio by 40% in a matter of months, I mean, that is a massive structural overhaul.
It requires an incredibly aggressive posture in the secondary market. To achieve that, they are currently marketing $1 billion of predominantly office loans for sale.
Right. They are putting it out there for buyers.
And they are also actively marketing their second largest owned real estate asset, which is a 686-key Hyatt Hotel in San Francisco.
Now, selling $1 billion in distressed debt is not like selling a stock on E-Trade.
Right. You can't just click a button.
No, it is a grueling process of bundling the loans, hiring brokers, and trying to find distressed debt funds willing to buy them at a price that makes sense.
But the strategy behind this exact loan sale sparked one of the most critical exchanges during the Q&A portion of the earnings call.
Oh, the Harsh Hamnani question.
Yes, Harsh Hamnani, an analyst from Green Street. He asked a highly pointed question that cut right to the core of their strategy.
He essentially asked, are you selling these office loans just to get rid of non-earning assets so your short-term earnings metrics look better? Or is this actually about long-term shareholder value?
Right. Hamnani was probing for a classic corporate accounting maneuver.
Explain how that maneuver works.
So if you have a loan that is in default, it isn't paying interest. It acts like an anchor dragging down your distributable earnings. If you sell that bad loan, even at a massive discount, it stops dragging down the DE, and your current quarterly earnings suddenly look much healthier to the market.
But by selling at the absolute bottom of the market, you lock in a massive permanent loss of shareholder equity.
Exactly. The analyst pointed out that office fundamentals in certain markets are actually starting to show slight signs of stabilization.
So his implication was that if BXMT simply held on to these loans and waited a year or two, the recovery value might be significantly higher.
He's basically saying, are you just doing this for earnings management today?
And Tim Johnson's response to this was very deliberate. He emphasized heavily that this is an, quote, optional sales process.
They aren't being forced to sell.
Right. They are not forced sellers facing a liquidity crisis. He framed the sale entirely around long-term value creation, arguing that the opportunity cost of holding dead assets is just too high.
So they want to rotate out of office and recycle that capital into sectors where they see significantly better risk-adjusted returns today?
Yes. But he also established a clear floor. He made it clear that they will only transact at levels they deem attractive.
Because in the distressed debt market, buyers demand a haircut, right?
Huge haircut. Meaning they want to buy a $100 million loan for maybe $60 million or $50 million.
And Johnson is signaling to the market that if the bids come back at 30 cents on the dollar, BXMT is fully prepared to reject the bids and just hold the loans.
But if they reject the bids and hold the loan, and the borrower still refuses to pay, we have to talk about what happens next.
Right, because this introduces a critical piece of industry mechanics. REO, or real estate owned. What actually happens when a commercial debt fund is forced to foreclose?
When a borrower defaults and the lender exhausts all restructuring options, the lender takes the property through foreclosure.
Yeah.
At that exact moment, it ceases to be a loan and becomes REO, real estate owned.
It moves directly onto the lender's balance sheet as a physical asset.
Exactly. And we saw this play out in real time during Q2 with a Dallas multifamily loan. BXMT was forced to foreclose on the apartment complex. When they took ownership, accounting rules required them to immediately mark the asset to its current market value.
So they had to officially recognize that the Dallas apartment building was worth significantly less than the loan they had written on it years ago.
Precisely. That single foreclosure resulted in a $29 million realized loss hitting the books in Q2.
Ouch.
And on top of taking the loss, BXMT is now acting as the landlord and operator of a Dallas apartment building.
Dealing with property management, maintenance, tenant leasing, all of it.
Right. And that is absolutely not what a massive debt fund wants to be doing with its time or capital.
Which is exactly why they are so desperate to sell that Hyatt Hotel in San Francisco. They foreclosed on it previously, it became REO, they took the initial pain, and now they just want the physical building off their books so they can turn it back into liquid capital.
Get the cash back.
Exactly. Here's where it gets really interesting. To use a relatable analogy, this isn't just trimming the fat. It's like having a garage sale where you sell off your massive, expensive, but broken antique furniture at a loss if you have to, just to clear out the room.
That's a perfect analogy. Management isn't just reorganizing the deck chairs. They're actively throwing the heaviest, most dangerous cargo overboard.
Because lightening the load is the only way to keep the ship upright and maneuverable enough to reach calmer waters.
And the strategy is generating massive amounts of liquidity.
Yeah.
In Q2 alone, they raised $1.2 billion in cash from loan repayments.
Okay, so they're clearing out the room, dumping the heavy cargo, they're taking their lumps on the balance sheet, and they are stockpiling all this cash. The obvious question is, what exactly are they buying to replace the old furniture?
Right. What are the new frontiers?
The transcript outlines a dramatic pivot from defense to offense. In Q2, BXMT closed $1.4 billion in new investment volume.
They lent out $1.4 billion of fresh capital. And the most striking data point surrounding that deployment is the structural size of these new loans.
The granularity, right?
Yes. The transcript notes that their average investment size for these new loans is just $20 million.
$20 million.
Yeah. A few years ago, their average investment size was routinely over $130 million.
Wow, so from 130 down to 20, that is a fundamental shift in how they view risk.
It's a massive pivot from high concentration risk to high granularity risk.
Make that real for us. Why does that matter so much?
Well, if you make a $130 million loan on a single skyscraper in Manhattan or a massive office park in Chicago, your fate is entirely tied to the microeconomy of that one specific block.
And the competence of that one specific borrower.
Exactly. If that one building fails, like the $345 million Chicago default we just analyzed, it blows a massive immediate hole in your balance sheet.
But if you take that same $130 million and break it up into 6 or 7 different $20 million loans.
Spread across residential properties in Texas, industrial warehouses in Ohio, and retail centers in Florida, you have instantly de-risked the capital.
Right, because if one of those $20 million borrowers goes bankrupt, it is a paper cut to the balance sheet, not a fatal wound.
The granularity is a defensive mechanism. But the sectors they are deploying this granular capital into are entirely offensive.
Mm-hmm. Yeah, this was wild to me. The most surprising revelation on this earnings call was their aggressive entry into homebuilder finance.
It's a huge shift.
The transcript details an initial investment of $130 million through a newly established joint venture specifically designed to finance single-family home construction.
And President Austin Peña spent a significant amount of time on this?
He did. They are targeting a total addressable market, or TAM, of roughly $200 billion in the home builder space.
So what does this all mean? Are they abandoning the city skylines to build suburban subdivisions?
It looks entirely out of character until you look at the macroeconomic dislocation that actually created the opportunity.
Okay, what happened?
Peña laid out the exact mechanism driving this. Historically, if a mid-sized developer wanted to build a subdivision of 50 single-family homes in a growing market like Texas or North Carolina, they would rely entirely on their local regional bank for a construction loan.
Right, the local bank down the street. Yes. Regional banks were the lifeblood of residential construction. But the regional banking crisis of 2023 changed the entire landscape.
When Silicon Valley Bank and Signature Bank failed.
Exactly. Those catastrophic failures triggered massive deposit flight from regional banks across the country. And in response, federal regulators clamped down hard.
The Basel III endgame rules.
Right. They initiated new capital requirements, which forced banks to hold significantly more cash in reserve for every risky loan they keep on their books.
And construction loans are inherently risky, right? Because you are lending money based on the future value of a house that hasn't even been built yet.
Precisely. Because of the deposit flight and the new capital requirements, regional banks looked at their balance sheets and aggressively pulled back from commercial real estate and construction lending.
They simply do not have the regulatory breathing room to make those loans anymore.
No. That regulatory shift essentially evaporated a massive source of funding overnight, leaving a $200 billion void in the market for homebuilder finance.
And when regulated banks are forced to step back from a lucrative market, the shadow banking system always steps in to fill the void.
Every single time.
BXMT is an alternative capital provider. They are not a regulated deposit-taking bank, which means they aren't bound by the exact same strict capital reserve requirements that force the regional banks out.
And because the traditional competition has vanished, the market is highly fragmented. That gives lenders like BXMT incredible pricing power.
CEO Tim Johnson was very explicit about the economics of this pricing power. He stated on the call that they are targeting, quote, mid to high teens levered yields in this sector.
Which is incredible.
When we talk about analyzing a stock or a company strategy, hearing mid to high teens levered yields on debt should make any investor sit up and pay attention.
Definitely.
For you listening, the levered part of that phrase is doing a massive amount of heavy lifting here. It means BXMT isn't just lending their own cash.
Right.
They are borrowing money at a lower rate, say 6% or 7%, and then lending it to the home builder at 10% or 11%. When you factor in the leverage, the actual return on BXMT's own equity jumps into the 15% to 19% range.
Which is huge. Yeah. Earning mid to high teens on senior secured debt is an incredibly lucrative position to be in.
It really is.
It is a textbook example of capitalizing on market dislocation. The U.S. housing market remains structurally undersupplied.
Oh.
There is a massive multi-million home deficit in the country.
Demand from home buyers is high, supply is constrained, and the traditional lenders who usually finance the new supply have just fled the field.
It is a perfect, highly profitable setup for institutional capital.
Right.
But home building isn't their only new frontier.
Right.
They're also aggressively scaling their net lease portfolio.
The transcript shows their net lease portfolio has ballooned to $661 million in total value, with $135 million of that closing just in the second quarter.
And for anyone unfamiliar with the term, a net lease, often called a triple net lease, is a highly specific type of real estate agreement.
Right. Explain how that differs from a normal lease.
So normally a tenant pays a flat rent. In a net lease, the tenant doesn't just pay rent. The tenant is legally responsible for paying the rent plus the property's operating expenses.
Which usually include the real estate taxes, the building insurance, and the maintenance costs.
Exactly. From an investor's perspective, a net lease is essentially a bond wrapped in real estate.
Because the tenant handles the roof repairs, the tax hikes, and the insurance premiums, the landlord's cash flow is incredibly stable and predictable.
It is a long-term, steady cash flow business that acts as a perfect counterbalance to those higher-risk construction loans they're making.
What is particularly notable in the transcript is the strategic choice management made regarding how to actually build this net lease portfolio.
Yeah, Austin Peña explained that when they decided to enter the net lease space, they faced a classic corporate dilemma: build or buy.
Right. They could have easily gone into the market and just bought an existing, fully operational net lease platform to scale up instantly.
But buying an established platform means paying a massive premium to the seller for the convenience.
So instead, they chose to build it entirely from scratch. They hired a dedicated internal team and are leveraging Blackstone's massive proprietary global data network to underwrite and acquire properties one by one.
Pena referred to this strategy as capturing the aggregation premium.
The aggregation premium is such a fascinating concept. If you buy a massive prepackaged portfolio of 100 industrial warehouses from another fund, you are paying top dollar because the hard work of assembling them is already done.
Right, you pay for the package deal.
But if you have the manpower and the data to go out and buy those 100 warehouses individually from smaller regional owners, you can acquire them at a significant discount.
And once you bundle those 100 individual assets together on your own balance sheet, the portfolio instantly becomes more valuable to institutional buyers simply because of its scale.
They are doing the hard work to create that premium for their own shareholders rather than paying it to someone else.
It requires immense operational discipline to deploy $1.4 billion in a single quarter through these granular individual transactions.
Yeah, that's a lot of individual deals to close.
It is. But to execute a $1.4 billion deployment strategy while simultaneously stomaching 80 cents per share in credit loss reserves on the legacy portfolio, a company needs a bulletproof financial foundation.
You need an absolute mountain of cash.
And you need a debt structure that won't collapse under the weight of those impairments.
Which brings us to the war chest. This aggressive reinvestment strategy requires massive liquidity. The sheer scale of the Blackstone machine becomes highly apparent when you look at their liquidity metrics.
We mentioned earlier that they received $1.2 billion in loan repayments in Q2 alone.
The transcript specifically notes that almost all of those repayments were from seasoned loans originated before 2023.
Which means they're older performing loans. The good assets are successfully paying off and handing cash back to BXMT.
And the velocity of that cash flow actually accelerated after the quarter ended. Austin Pena noted that in July, just the few weeks leading up to the earnings call, they collected another $1.4 billion in repayments.
That included a massive 450 million euro paydown on a single mixed-use loan position in Dublin, Ireland.
So the cash is just flowing in at a staggering rate. The transcript states they officially had $1.2 billion in available liquidity at quarter end.
And they're also playing defense on their own corporate debt.
Right. In May, they proactively issued $450 million in senior secured notes, specifically to pre-fund their debt maturities coming due in 2027.
Because of that move, they have absolutely no corporate debt maturities until 2029.
They have bought themselves years of runway. But if we are providing a truly objective analysis of this earnings call, we have to push back on a major point of concern on the balance sheet.
We have to talk about the leverage.
Exactly. Wait, their debt to equity ratio went up to 3.9x in Q2. It was 3.7x in the first quarter. That is pushing the upper edge of their 3 to 4x target range.
CFO Marcin Urbaszek attempted to brush this off during his prepared remarks.
He framed it as a temporary timing issue, right?
Yeah. Driven by the timing of those July repayments and the accounting impact of the CECL reserves, he noted that their historical target range is 3 to 4 times equity anyway.
But if I am a retail listener holding or considering this stock, and I see a company taking massive impairment hits, foreclosing on properties, and simultaneously pushing the absolute upper limit of their leverage target, I am going to be deeply worried.
Understandably so.
A 3.9x leverage ratio means for every $1 of equity they have borrowed nearly $4. In a declining real estate market, high leverage is precisely the mechanism that bankrupts lenders. Why isn't management panicking about being pushed to the edge of their leverage limits?
It is a completely valid concern. But the reason they aren't panicking comes down to exactly how that debt is structured.
Okay, this is key.
This is arguably the single most important technical detail buried in the transcript.
Oh.
CFO Urbaszek stated that 88% of their total debt is non-mark-to-market.
Okay.
And they have zero capital markets mark-to-market provisions in their entire capital structure.
We have to translate that immediately because the presence or absence of mark-to-market provisions is literally the difference between surviving a downturn and being forced into bankruptcy. What exactly is a mark-to-market provision, and why is it a superpower for BXMT not to have one?
The easiest way to understand this is to use a margin loan on a personal stock portfolio as an analogy.
Perfect.
If you borrow money from your broker to buy stocks, your broker uses those stocks as collateral. If the broader stock market suddenly crashes, the value of your collateral drops.
Right.
Your broker will look at the new lower market mark of your portfolio and issue a margin call. They will force you to deposit more cash immediately to cover the difference.
And if you don't have the cash,
they will unilaterally sell your stocks at the absolute bottom of the market to pay themselves back. It creates a death spiral.
In commercial real estate finance, the mechanics are very similar, aren't they? Massive debt funds like BXMT don't just use their own money.
No, they borrow billions from massive global banks using warehouse lines and repo facilities, and they use the real estate loans they've made as the collateral for that borrowed money.
Exactly. And historically, those warehouse lines had mark-to-market provisions. If the commercial real estate market dropped, the massive global bank could issue a margin call on the debt fund, demanding more cash because the underlying collateral lost value.
Which is exactly what happened in 2008. This exact mechanism is what bankrupted countless real estate funds during the financial crisis.
They didn't go bankrupt because their properties were empty. They went bankrupt because their lenders issued margin calls they couldn't pay.
Precisely. So when BXMT emphasizes that 88% of their debt is non-mark-to-market, they are declaring that their lenders fundamentally cannot issue a margin call just because the estimated value of the office market drops.
As long as the underlying borrower on the real estate keeps making their monthly interest payments, BXMT's corporate lenders cannot force them to post more collateral.
It is an incredible structural shield. It allows BXMT to survive market panics, hold struggling assets through the absolute bottom of the cycle, and restructure messy loans like the Chicago office building without a gun to their head from their own creditors.
This structural advantage is also being supported by a surprisingly robust, broader financing market. Tim Johnson mentioned on the call that CMBS commercial mortgage-backed securities issuance is currently tracking near a 20-year high.
Which is vital context.
CMBS is essentially Wall Street taking a bunch of commercial mortgages, bundling them together, and selling them as bonds to investors. The fact that the CMBS market is wide open is a literal lifeline for BXMT.
It is the exit strategy for their borrowers. If a borrower has a loan maturing with BXMT, they need to find new money to pay BXMT back.
Right.
With the CMBS market functioning at a 20-year high, those borrowers can go to the CMBS market, get a new loan, and hand that cash to BXMT.
If the CMBS market was frozen and illiquid, those borrowers wouldn't be able to refinance, they would default, and BXMT wouldn't have been able to collect that crucial $2.6 billion across June and July.
Exactly. But this exact tension we just mapped out between having strong structural liquidity on one hand, but high leverage and rising impairments on the other, is exactly what the Wall Street analysts zeroed in on during the Q&A.
Yeah, this is where it gets spicy. The Q&A portion of this transcript is where the polite corporate presentation collides violently with the cold reality of Wall Street financial models.
Analysts aren't there to listen to the spin. They are there to stress test the math. And the first analyst out of the gate was Rick Shane from JP Morgan.
And he went straight for the jugular, the dividend policy.
We touched on this earlier. Distributable earnings were 31 cents, but the dividend they paid out was 47 cents.
That is a glaring 16-cent shortfall per share. Shane asked, very politely but very firmly, how management is thinking about the dividend policy going forward if this shortfall persists over the next 2 to 3 quarters.
To understand Shane's angle, you have to look at the breadcrumbs the CFO dropped earlier. Marcin Urbacek had already admitted in his prepared remarks that Q3 earnings are going to face a significant drag.
Right. The new loan impairments they recognized in Q2 will stop generating interest income.
Furthermore, the massive $1.4 billion they got back in July is currently sitting in cash. It takes time to redeploy that capital into new loans that actually earn interest.
So Shane is doing the forward-looking math in real time. He sees the earnings drag coming and is directly asking, are you preparing the market for a dividend cut? When an analyst asks a CEO, quote, how far forward do you look in setting that policy? What they are really asking is, are you about to slash the dividend? How many quarters of a severe cash shortfall will your board of directors tolerate before they cut the payout to protect the balance sheet?
If we connect this to the bigger picture, Tim Johnson's response was a masterclass in corporate maneuvering.
What did he say?
He didn't guarantee the dividend, but he aggressively defended it. He stated that the dividend is focused around the long-term earnings power of the business.
Right.
He acknowledged the short-term noise, the impairments, the friction of turning over $1 billion in the portfolio, but reiterated that the board evaluates the long-term, stabilized earnings power of the new assets they're bringing on.
If we translate that corporate speak, Johnson is essentially saying, please don't model a dividend cut for next quarter based on a temporary dip in earnings caused by this messy transition. Look at the $1.4 billion we just deployed at mid to high teens yields. Once that capital starts fully earning, the dividend is covered.
It was a robust defense, but it absolutely leaves the door open for a cut if the macroeconomic picture darkens further and those new investments don't perform as expected.
It was a highly calibrated response. Following Shane, Jade Rahmani from KBW stepped up and forcefully shifted the focus away from the office doom and gloom to an entirely different sector, multifamily housing.
Yeah, Rahmani pointed out a glaring issue in the apartment market.
He noted that apartment rent growth nationally was basically flat year over year, and in heavily overbuilt markets like the Sun Belt, rent growth was actually negative. He asked if borrowers are starting to panic about their ability to cover their debt service in a high-rate environment when their rental income is stagnating.
This is a critical vulnerability for BXMT because multifamily makes up a massive portion of their total portfolio.
Right. If multifamily starts cracking and defaulting the way office buildings did, their systemic problems multiply exponentially. The thesis is that if rents drop, the building's value drops, and the borrower walks away.
But management's response here was surprisingly confident.
Tim Johnson countered the flat rent growth narrative with a different metric entirely. He pointed out that while rents aren't skyrocketing, net absorption nationally in the first half of the year was the strongest it has been in 5 years.
And net absorption simply means the total number of apartments that became occupied minus the number that became vacant. It measures raw physical demand.
So Johnson is arguing that despite a temporary glut of new supply keeping rents flat, people are still actively moving into apartments at a historically high rate. The fundamental demand is completely intact.
And he brought the financial data to back up the physical data. He noted that BXMT has received $5 billion in repayments, specifically on multifamily loans originated in 2021 and 2022.
Wow, $5 billion.
Yeah. That $5 billion number is the ultimate proof of concept. It proves that the broader market, other traditional lenders, and the CMBS markets is still highly willing to finance these properties.
Because if the broader multifamily market was terrified of flat rents, those borrowers would never be able to secure refinancing, and BXMT would not be getting paid back. Finally, Marissa Lobo from UBS brought the conversation back to the central crisis, the office sector. She noted that management claimed nearly half of their performing non-watch-listed office loans are currently in the market looking for refinancing.
Which is a lot of volume.
It is. So she asked the multi-billion-dollar question. With the 10-year treasury up again, are lenders actually going to refinance these office buildings? And what is your backup plan if they refuse?
Austin Pena fielded this one, and he pointed right back to the sheer volume of liquidity currently active in the debt markets. He referenced the $1.5 billion they collected in July as proof of life.
Right.
He argued a fundamental point about the current market structure.
Yeah.
There is still immense demand from lenders to finance good real estate assets, even in the hated office sector.
But with conditions.
Yes, provided they are high quality, fully leased, and performing well.
It is a massive bifurcation in the market. It is a tale of two entirely different asset classes that just happen to share the label office. The Class A, highly amenitized, fully leased office buildings can still attract capital. The aging Class B assets facing tenant flight are the ones ending up as $345 million defaults in Chicago.
The overarching theme of the Q&A revealed that Wall Street analysts are cautiously optimistic about the pivot, but they are demanding hard proof of execution.
Yeah, they want to see that this massive, highly complex portfolio rotation, dumping $1 billion in distressed office loans, building a home finance engine from scratch, and scaling a net lease platform will actually protect the dividend and shareholder value in the long run.
Rather than just resulting in a series of painful, permanent write-offs.
And that brings us to the bottom line on this earnings call. For anyone analyzing this stock, Blackstone Mortgage Trust is essentially a perfect microcosm for the violent transition of the entire commercial real estate market right now.
It really is the canary in the coal mine.
The legacy assets of the last decade, the massive ego-driven office towers, are actively bleeding out due to structurally higher interest rates and a fundamental shift in how businesses use space.
But instead of hiding behind accounting tricks, extending bad loans, and pretending everything is fine, BXMT is aggressively amputating the infected debt.
They are taking massive hits to their book value, marketing $1 billion of bad loans for sale at a discount, and utilizing their bulletproof, non-mark-to-market liquidity to execute a radical pivot.
They are plowing billions of dollars into highly granular, high-yield assets like single-family home building finance and triple-net industrial properties,
capitalizing on the exact moment that traditional regional banks are forced to retreat.
The final analytical insight here is that investors must keep the scale of this portfolio in perspective. A 97% performing portfolio, which is what BXMT reported at the end of a highly volatile Q2, is still a massive operational success in this brutal macroeconomic environment.
Yes.
However, the execution of this pivot is everything. The speed at which they can actually clear out that $1 billion loan sale, the severity of the discount they have to take to clear it, and their ability to immediately redeploy that cash into mid-teens yielding homebuilder loans will entirely dictate their trajectory and the safety of their dividend as we look toward 2027.
It is an incredible high-wire act with billions of dollars of institutional capital on the line. And as we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought to mull over regarding the broader implications of this transition.
It's a big one.
We talked in depth about how traditional, heavily regulated regional banks are so constrained by the current market and new capital regulations that they are leaving a massive $200 billion hole in residential home building finance.
Right.
We're watching shadow banks, alternative capital providers, and mortgage REITs like BXMT eagerly step into that exact void to capture those high teens profits. But what does that structural shift mean for the systemic risk of the everyday housing market 5 years from now?
Are we actually making the broader financial system safer by pushing regional banks out of the construction lending market?
Or are we simply quietly moving the inherent risk of real estate development away from highly regulated hometown banks and placing it directly onto the balance sheets of Wall Street investors and private credit funds?
It is a structural shift that will likely define the financial stability of the next decade, and it is happening right out in the open.
It truly is. Thank you for joining us on this deep dive through the numbers, the strategic narrative, and the rapidly shifting future of commercial real estate. Keep a close eye on these macroeconomic shifts, and we will catch you on the next deep dive.